The class is starting.
There you go, thank you. Did I make that crooked?
No, it's the projector.
It's
Oh,
the
it
room.
just does that. Okay.
It's the room.
The room's crooked.
Thank you, Les, for the announcement.
Well, Molly.
Oh, got the big camera, huh?
Yeah,
Did
perfect.
it go with it?
That's
Huh?
perfect.
Did it go with it?
What?
Yeah, that's
The
higher
house,
too.
Teakwood.
Yes, yes, we did.
Just think that.
So he's signed it, I have to get his wife signed tonight and then deliver the check.
Good.
And they're doing the inspections today.
The inspection's happening today.
Which house is this?
The first of many, I think. Teakwood?
The first of many.
Yeah.
Trying to
Well,
confuse
because
me
there's
in the early in the
foundation work
morning.
done, I'm sure
Me.
they'll have an inspection done. They'll have the same foundation company back to inspect it.
Do you want a handout?
Okay.
Yes, please.
Well, because the report, you know, it's all in the information, but there's no warranty because the owner previous to him didn't know that there had been foundation work done, so they didn't maintain the warranty. The foundation company won't come out, inspect it, and reinstate the warranty, so I'm just like, great, fine, whatever. Moving on.
Is this that first house you listed?
No, the second, the first house is still out there.
Hey, is it really?
Did you ever go
Okay.
see it?
I haven't. I was just asking you to make sure that it was still there because I am going to go out.
Go
and take a
see
look
it,
at
go sell it. Go find someone that wants a pool. Wait till next week to take them, because it's gonna be freezing.
Freezing
again.
cold here. When you come tomorrow.
Oh, thank you.
Hi, thank you.
And I gotta get out there at 4
Nice.
o'clock again tomorrow morning.
My copying got a little sideways. I didn't want it to copy that way, but it did, or when I printed. So you'll have to flip.
It's wrong. It's okay.
It's just upside down.
Oh, is that it? I thought
think
maybe it was
so
Spanish
it would
on
be
the
a
opposite
booklet.
side.
Yeah, it works for me.
Yeah.
Yeah, it works for me too.
Okay, good.
Why didn't it work for
Are
me?
we have more, or we?
Go ahead, her door is closed, I don't know what's, she was coming, she was supposed to be here.
Michelle?
She'll probably come in, yeah.
Yeah, she'll be in.
All right, no problem.
Okay.
Okay, so I'm Shelly with Prime Lending, for those of you that don't know me. And I've worked with Molly a long time ago.
And here, when we first opened her office, she actually officed within her office.
Oh.
So she was our in-house lender.
Yeah, yeah, so, and this stuff is new, you know, all the new Dodd-Frank, and there's been so many rumors and so much speculation about it that Prime, actually, we came up with this class. First of all, they had to teach us, and then for us to teach you guys. And really, it alleviates a lot of fears, I think. But I'm gonna go through the whole thing. You guys can stop me and ask me questions as we go. And basically, all of these new rules, they were in effect they were made 3 years ago, but they finally went into effect January 10th of this year. And, okay, so me with no picture, but, okay. So January 14th, these are the rules that came into effect. And there's several different sections. I think the one that has the most question is called the QM, or the Qualified Mortgage Loans and Ability to Repay. A lot of this stuff, y'all, we're already doing, so I don't think it's gonna come to a big deal. This one scared a lot of people, this points and fees cap, because what it's saying is if your loan amount is over 100,000, total fees, and these include some title fees, and most all of the lender fees, cannot exceed 3% of the loan. Under 100,000, it's tiered, and it gets, they have higher numbers the lower it goes. So I think in the beginning, we didn't realize that they were gonna start it at 100. So that was a concern when you got to an $80,000 loan. How can all those fees be charged and stay under 3%? The other part of it that we had a lot of speculation on was, what if your borrower wanted to, your buyer said, okay, the rate's 4.5, but I want 4 and I want to pay a point or 2 points to do that? And if they did that, then would that count in the 3%? And then now can we not let people buy rates down? It didn't seem fair to the consumer. When all this came about, almost every mortgage company I know in January implemented systems that lock us into these compliance rules, so they red flag us and won't let us move forward if we're doing something wrong. But what I found on the points for discount for your guys buying their rate down is we have a calculation, and if it's a bona fide discount and we can show the rate was higher without it, then it's excluded from that 3% cap. And I'm just telling you that because it just seems like there was a lot of hysteria, at least we were hysterical about it, because we thought, how can we tell people they can't do that if they want a lower rate? Does that make sense? Okay. The maximum debt to income ratio. These are conventional loans only, by the way. FHA and VA have not adopted this, so this is conventional loans only. The rule until January was 45%, and that went down from 50 about 3 years ago, and from back in the day when we could go even higher if we could make it run through our automated system. So I don't think the drop from 45 to 43 is a huge difference. And that's looking at max debt. You know, you guys know what debt to income is, right? Everybody? Okay. So I'm going to get to something later, though, that explains to you that all of this we're learning on this portion, this QM portion. There's a 7-year, I don't know what they call it, I want to say moratorium, but we have 7 years to comply with this. So I know in my office the other day, I had somebody I was working on their loan, and they were at a 45, and I went to my manager and said, you know, they went higher than I told them, they're at a 45, and she said, oh, well, you've got your 7 years, you're fine if everything else is good. So we were all scared about that, but we really, and I think depending on the lender, I know for us, if they've got a 45, we can still do them for the next 7 years. So that's a pretty cool thing to know. This other section down here is stuff you didn't want anyways for your clients, and we don't do them. So there's no negative amortization. There's no more balloon payments. Second liens don't have to comply with this, I don't believe, and I'll get to that. So they can still do, if you guys do a lot of second liens, they always have that 30 due and 15 a lot of times. I've been doing a lot more second liens lately because people don't want mortgage insurance and second liens are coming back. But I really don't give balloons anymore. Most people have been scared enough, so they either do a straight 15 or a straight 20, and the payment is so low on those, it usually, and the rate's lower if they do it that way. So most people go with that. Y'all have questions on second liens? Everybody know kind of how to do that?
I was just gonna ask you to talk a little bit about that.
Okay, so it's really for conventional loans and sometimes works with jumbo loans too. If somebody wants to only put 5 or 10% down, but they don't want mortgage insurance,
Right.
we can structure what we call an 80-10-10 or an 80-15-5, which means they put 5 or 10% out of their pocket. They get a first lien at 80% of the sales price and a second lien at 10 or 15%. They have 2 liens and 2 different lenders. We don't do them. I use IBC First Equity. The rates run from about 5.75 to maybe 6.5, depending on the program they choose. And they have to meet pretty decent criteria.
Sure.
Their credit scores, especially on those 5% downs, they have to have a 720. If they're a first-time home buyer, they have to meet some other criteria. And I can actually share those little, it's a one-page guideline IBC has. But it's nice because a couple of things. They don't have mortgage insurance. The payment typically comes out cheaper than a regular 5 or 10% down with mortgage insurance.
That's what I was just gonna ask you, how.
It's always cheaper. It depends on the loan amount, but I've never seen it come higher. They have about $600 more in fees at closing because they pay that second lien lender some fees. But they're also not giving their money to a third-party mortgage insurance company, and it's not that I hate mortgage insurance companies, but most buyers don't want to give their money just to somebody else. They're actually, when they're making that second lien payment, they're paying down their principal. And if they want to pay anything off early and they can pay that off early as opposed to their first lien, then they're sitting really nice with the 80% loan to value, no mortgage insurance. So I think they're cool. I used to do a lot of them. When we had the mortgage crisis in 2008, a lot of the second lien lenders disappeared because when people foreclosed, they were in a second lien position and they lost. But they're coming back because the market's stronger. And the rates are, when we used to do them back in 2005, the rates were around 8%. And now they're so low, it's nice to the monthly payment. And it's also really nice if you've got somebody that's buying a house over the conforming limit, over 417, and they can put, you know, the guidelines on a jumbo loan are more strict once you're over 417. It's 20% down, the rates are higher, and the criteria sometimes is crazy. They have to have a lot of reserve money. But if I can structure it where they do 10 or even 15% down, get a second lien, and then that first lien is under 417, that's really nice because then they've got a lower interest rate and they don't have to meet all that additional criteria, and they can get out with less than 20% down. So That's a little off what we're doing here, but it's kind of,
And keep in mind, the interest rate is tax deductible
right.
for now. As long as we still have that.
And
Um,
PMI is not.
Right, and PMI is not, so you have that benefit. And another thing is too, is one, I've always liked to use, a second when you have somebody that is like, gets bonuses or commissions or something, because I've always told them, you can pay the second off, and you always wanna make sure there's no penalty for paying, early paying it off, or,
And sometimes
And-
it's like 2 years or something.
Not anymore.
Not anymore?
No more,
Okay.
they're gone. So no more
Yeah.
prepayment penalties on those seconds.
so that way, when they get, you know, a big bonus, or they have good commissions or something, they can actually pay that off and have their overall house payment go down, because now they just have the one. So it's, you know, when people realize all the benefits, it becomes a lot more attractive to them.
Yeah, and just when they see it on paper, I mean, on paper, the payment's cheaper. It really is. And I do, sometimes I'll have people who are qualifying, you know, they're keeping their current house, they don't wanna sell it till later, but they're gonna sell it eventually, and then they can pay that second off that way too, so.
Right.
And no more interest-only loans, so, which is good. And there was a time when some people, we haven't done them in years, 40-year loan term, and those are gone. 30 is the max loan term allowed now.
On your fees,
Yes.
that 3%,
Yes.
does that include the seller paid title policy?
If it's on, no.
No,
Anything that's
okay.
on the HUD that goes to the seller does not have to be included.
Okay,
So, it includes mortgage insurance though, that's the tricky part, if it's upfront. That's another side issue, but you know, we all think of monthly mortgage insurance premiums, and conventional loans have really pushed, and they're cool products. A single premium upfront that can be financed in or paid out of pocket, or a split like an FHA because if you compare the split conventional to an FHA, it's much cheaper. So they could do a upfront fee that got financed in or paid out of pocket, and then have a lower monthly, and it would rival FHA by quite a bit. Dodd-Frank was including that in that 3% cap, that upfront. And so mortgage insurance companies thought if they made it refundable after a certain amount of years, they'd be excluded. And then right after January 1st hit, Dodd-Frank, the Consumer Financial Protection Bureau came out and said, any upfront mortgage insurance is in that 3% cap. And see, that was another alternative to second liens or to monthly mortgage, was this upfront. But what they did say is if the seller paid it, that upfront mortgage insurance, it wasn't included. So that's another cool way to get rid of mortgage insurance monthly. And as long as they have a decent credit score, if they have a 620, it's almost 4% upfront. It's ridiculous. The split is pretty nice. They can also have the lender can't pay it, but we can lender credit them for it by pricing the loan a little higher. It's what we were talking about earlier. I can price a loan 1/8 to 1/4 point higher and give cash credit towards buyers at closing. So that's another way to cover that upfront mortgage insurance. Anything that's on the HUD as a lender paid or a seller paid doesn't have to go into that 3%.
okay.
So the ability to repay, this is the stuff that I'm telling you we've all been doing for a long time, because y'all know it's been harder for your people to get loans, that, you know, we ask for everything and over document. I really saw this hit back in September. I think we were gearing up for it, and so we did it early so that we'd be prepared. Our underwriters they just have to be a lot more stringent on what we get, but we were already getting full income and asset verification. Employment, you guys know, 2 years. There's things they can do. If they were in school 1 year, 6 months actually is fine. If they were in school, if they're returning to the workforce and they can prove a 2-year history prior, then 6 months on the job is allowed on a conventional. So, but all of that just has to be documented now. And it can't be a letter from the borrower. You know, we have to have his tax returns or W-2s from before, or verification showing he actually did have this job 2 years ago, or a job similar, and was in the workforce. And it works. I mean, I've had people that have been out for 10 years and they can come back and get a loan if they're going back into the same field and they're 6 months on the job. We have to include all monthly mortgage payments in their debt to income ratio, all other mortgage related debt, including alimony and child support, and we've done all this. and the reason though this is listed a lot, that DTI is debt to income, is residual income. Dodd-Frank was telling us, and I don't know if y'all know this, on VA loans, when we do a VA loan, always, we have to do this calculation that shows how much money they have left over every month after they have all these payments. And it's a VA chart that we use. And then VA has criteria for certain regions of the country and how many are in their family, how much money they have to have left over, and if they don't qualify. And VA's chart's pretty strict. I mean, it includes a lot of things. Dodd-Frank really didn't tell us how we were gonna have to do this residual income on conventional loans. And what we did find out is we only have to do them if it's what's called a high price mortgage loan, which I'm gonna get to, which we're not gonna really see much of. But the chart is real simple. And I think if anybody's gonna qualify and hit that 45% or under ratio, they're gonna have enough money left over. We don't include all the things that's included on a VA. We don't factor in utilities or maintenance. It's just looking, we have a very, Prime Lending developed their own, because they told us we could. So ours is just based on their credit, what's on their credit report and what their new monthly income's gonna be, and any alimony or child support. But, and we just got a bulletin from the head underwriter the other day, and she said, I really don't think you're ever gonna use this chart, and I think it's a non-issue, but here it is. I don't think it's a big deal. And obviously credit history. I'm making people a lot more just give me letters of explanation on credit up front. You know, my deal is if I over document in the beginning, it's better than getting it into underwriting and them asking for stuff, slowing down your process and making buyers unhappy because we keep coming back and saying, I need one more thing. If we can think of what we need at front, you know, and if I can explain it to them well enough, you know, it's not you, I do this to everybody hates me, this is what I do, then they would prefer that, I think, than to be a week away from closing and we're nickeling and diming them for stuff, so. It's just being diligent.
I need to ask you a question. On the employment, when you have somebody that's getting, you know, graduating from college.
Right.
And going into their
Profession.
that, you know, what they studied for. What's the time frame? Did you say 6 months?
No, if they're going, that's somebody returning to the workforce.
Oh, okay.
If they're going straight from college to a job, they can be on I just need a paycheck.
Just one paycheck?
One paycheck. Now, if they're a professional, certain criteria, nurse, doctors, teachers, and they actually have an employment contract, you know, they've gotten a letter of, and it doesn't have a probationary period on there, which is kind of hard to find. We'll allow them to close without their first pay stub, and then we have a follow-up that they agree, they sign an affidavit that after closing, they'll give us their first pay stub. So it's sort of case by case. If you have somebody like that, let me talk to them, let me get their employment contract or their offer letter, and I can look at it and tell them if we can do it. But we're pretty, more lenient than other places I've worked on that. As long as, again, it's a professional field and they're gonna get a paycheck, hopefully before their first payment is due. Make sense?
Mm-hmm.
Okay. Okay, so what is the consumer impact? Some lenders may not originate non-QM loans. Nobody really knows what they're gonna do with non-QM loans. Non-QM is the ones that don't meet these criteria. For the next 7 years, it's sort of a non-issue because they can still be done. You know, they have that time frame that I was talking about earlier. Consensus in the industry is there will always be people who will do non-QM loans. It's Fannie and Freddie that are saying that we need the QM loans, but they'll take some non-QM loans direct. Obviously, people who portfolio their own loans will. And really, I think, again, the difference between how we underwrite now and how we're gonna underwrite to QM is a matter of 2% on the debt to income. Almost everything else we're already doing. So these, you know, looking at their ability to repay, getting all this documentation, not charging over a certain amount of fees, not doing negative AM loans, none of that's going on right now anyways. And if it is, then those lenders won't be able to do that anymore. And that's good. I mean, that's good for your consumer. They don't need balloon payments and negative amortization loans. The 3 points and fees caps provides consumers with a safety net and peace of mind that their fees will never exceed 3% of the loan amount. It prevents consumers from entering into loans with terms they may not be able to afford, like a balloon payment. This is what I was talking about. There's a 7-year temporary exemption for loans that do not meet QM standards, which may allow consumers with higher debt-to-income ratios to still qualify. We still have to follow. So if I'm going over the 43%, I still have to follow the 3% cap on fees. But we can sell directly to Fannie, Ginnie, VA, and USDA aren't doing this yet anyways, so. Lenders are still permitted to originate non-QM loans provided that the consumer demonstrates an ability to repay the loan. And additional documentation may be required of consumers to verify their ability to repay. Can't imagine what else we could ask for, but tax returns, W-2s, everybody's getting all that now anyways. There are some subprime people back out there that we're doing stated income loans again, and so those are the people that won't be able to do that anymore. Now there's different sections of the Dodd-Frank rule. So the next one is high-cost mortgages, Home Ownership Equity Protection Act. And what are high-cost mortgage triggers? So Dodd-Frank revised the thresholds for what triggered a high-cost mortgage. And basically what it means is that they're looking at the average prime rate instead of what the Treasury's yielding. So what's the average rate out there, the average prime rate? And I'll tell you what the amount is. I think it's on the next page. I hope I had a handout I didn't bring on it. It expands coverage of high-cost loans to include purchase, refinance, home equity loans that are closed-end, not lines of credit, open-end home equity loans secured by a principal. So that'd be